Welcome to our journey into the world of sustainable investing. In recent years, more and more investors are seeking ways to align their financial goals with their values, focusing on investments that not only generate returns but also create positive social and environmental impact. Sustainable investing, sometimes called responsible or ethical investing, is about making choices that support a better future. In this video, we'll explore what sustainable investing means, why it matters, and how you can get started. Let's begin by understanding the basics and setting the stage for a deeper dive into this transformative approach to finance. Sustainable investing is an investment approach that considers environmental, social, and governance (ESG) factors alongside financial analysis. This means looking beyond profits to assess how companies impact the planet, society, and their own governance structures. Investors who choose this path believe that companies with strong ESG practices are better positioned for long-term success. By integrating these factors, sustainable investing aims to create value not just for shareholders, but for all stakeholders, including communities and the environment. ESG stands for environmental, social, and governance. These three pillars form the foundation of sustainable investing. Environmental factors consider how a company manages natural resources and its impact on the planet. Social factors look at how a company treats its employees, customers, and communities. Governance examines leadership, transparency, and ethical practices. The rise of ESG investing reflects a growing awareness that these factors can influence a company's long-term performance and risk profile. Sustainable investing matters because it recognizes the interconnectedness of financial markets, society, and the environment. By considering ESG factors, investors can help drive positive change, encouraging companies to adopt better practices. This approach can also help manage risks, as companies with poor ESG records may face regulatory fines, reputational damage, or operational challenges. Ultimately, sustainable investing is about building a resilient portfolio that supports a healthier planet and society. There are several approaches to sustainable investing, each with its own focus. Some investors use negative screening, excluding companies involved in harmful activities like tobacco or fossil fuels. Others use positive screening, seeking out companies with strong ESG performance. Impact investing goes a step further, targeting investments that deliver measurable social or environmental benefits. Each approach offers a unique way to align your investments with your value. Negative screening is one of the oldest forms of sustainable investing. It involves excluding companies or industries that do not meet certain ethical or sustainability criteria. For example, an investor might avoid companies involved in weapons manufacturing, gambling, or environmental pollution. This approach allows investors to avoid supporting activities they find objectionable while still pursuing financial returns. Positive screening takes the opposite approach, actively seeking out companies that excel in ESG criteria. Investors look for businesses that lead in areas like renewable energy, fair labor practices, or transparent governance. By investing in these companies, you're supporting leaders in sustainability and encouraging others to improve. Positive screening can help build a portfolio that reflects your commitment to making a difference. Impact investing goes beyond screening by targeting investments that deliver measurable social or environmental outcomes. This might include funding clean energy projects, affordable housing, or healthcare initiatives. Impact investors seek both financial returns and positive change, often measuring their success by the real-world impact their investments create. This approach is gaining popularity among those who want their money to make a tangible difference. Shareholder advocacy is another powerful tool in sustainable investing. Investors can use their ownership stakes to influence company behavior, pushing for better ESG practices through voting and engagement. This might involve filing shareholder resolutions, meeting with management, or voting on key issues at annual meetings. By using their voice, investors can help shape corporate policies and drive meaningful change from within. ESG integration is about incorporating environmental, social, and governance factors into traditional investment analysis. Rather than treating ESG as a separate consideration, investors evaluate how these factors affect a company's risks and opportunities. This holistic approach can lead to better informed decisions and potentially stronger long-term performance. ESG integration is becoming a standard practice among institutional investors worldwide. Green bonds are a type of fixed-income investment specifically designed to fund environmentally friendly projects. These might include renewable energy installations, clean transportation, or sustainable agriculture. By investing in green bonds, you're supporting initiatives that help combat climate change and promote environmental sustainability, while also earning interest on your investment. Social bonds are similar to green bonds, but they focus on projects with positive social outcomes. These might include affordable housing, education, or healthcare initiatives. Investors in social bonds help address pressing societal challenges while seeking stable returns. This type of investment is ideal for those who want to make a difference in people's lives through their financial choices. Sustainable funds pool money from multiple investors to invest in companies or projects that meet ESG criteria. These funds are managed by professionals who research and select investments based on sustainability standards. By choosing a sustainable fund, you can diversify your portfolio and support a wide range of responsible businesses, even if you're new to investing. Thematic investing focuses on specific trends or themes, such as clean energy, water conservation, or gender equality. Investors select companies that are poised to benefit from these long-term trends. Thematic funds allow you to target your investments toward issues you care about, while potentially capturing growth in emerging sectors. Sustainable index funds track the performance of companies that meet certain ESG standards. These funds offer broad market exposure while excluding companies with poor sustainability records. Index funds are known for their low fees and simplicity, making them a popular choice for investors who want to support sustainability without active management. One common question is whether sustainable investments perform as well as traditional ones. Research shows that companies with strong ESG practices often outperform their peers over the long term. They may be better at managing risks, attracting talent, and adapting to changing regulations. While no investment is without risk, sustainable investing can offer competitive returns while supporting positive change. Sustainable investing can help manage risks that traditional analysis might overlook. For example, companies with poor environmental practices may face fines or cleanup costs. Those with weak governance could be vulnerable to scandals or mismanagement. By considering ESG factors, investors can identify potential red flags and build more resilient portfolios. Despite its benefits, sustainable investing faces some challenges. ESG data can be inconsistent, making it hard to compare companies. Greenwashing, where companies exaggerate their sustainability efforts, is another concern. Investors need to do their homework, using reliable sources and asking tough questions to ensure their investments truly align with their values. Getting started with sustainable investing is easier than you might think. Begin by clarifying your values and priorities. Do you care most about the environment, social justice, or ethical governance? Next, research investment options that align with your goals. Many financial advisors and online platforms now offer sustainable investment products, making it simple to take the first step. For investing, it's important to define your financial and impact goals. Are you looking for long-term growth, steady income, or a specific social or environmental outcome? Setting clear goals will help you choose the right investments and measure your progress over time. Remember, sustainable investing is a journey, not a one-time decision. Thorough research is key to successful sustainable investing. Look for funds or companies with transparent ESG reporting and third-party certifications. Review their sustainability policies, track records, and independent ratings. Many online tools and databases can help you compare options and make informed decisions. Financial advisor can help you navigate the world of sustainable investing. Look for advisors with experience in ESG or impact investing. They can help you clarify your goals, select suitable investments, and monitor your portfolio over time. Don't hesitate to ask about their approach to sustainability and how they evaluate ESG factors. Diversification is important in any investment strategy, including sustainable investing. Spread your investments across different asset classes, sectors, and regions to reduce risk. Sustainable funds, green bonds, and thematic investments can all play a role in building a balanced, resilient portfolio that aligns with your values. Once you've built your sustainable portfolio, it's important to monitor your investments regularly. Track both financial performance and ESG impact. Many funds provide annual sustainability reports showing how your money is making a difference. Adjust your portfolio as needed to stay aligned with your goals and changing market conditions. Greenwashing is when companies exaggerate or misrepresent their environmental efforts to appear more sustainable than they really are. This can mislead investors and undermine the goals of sustainable investing. To avoid greenwashing, look for transparent reporting, third-party certifications, and independent ESG ratings. Being vigilant helps ensure your investments truly support positive change. Regulation is playing an increasing role in sustainable investing. Governments and regulatory bodies are introducing new rules to improve ESG disclosure and prevent greenwashing. These regulations help standardize reporting, making it easier for investors to compare companies and make informed choices. Staying up to date with regulatory changes is important for all sustainable investors. Sustainable investing is a global movement, with investors around the world seeking to align their portfolios with their values. Europe has led the way, but North America, Asia, and other regions are catching up quickly. International collaboration and new investment products are making it easier than ever to invest sustainably, no matter where you live. Technology is transforming sustainable investing. Advanced data analytics, artificial intelligence, and blockchain are improving ESG measurement and transparency. Online platforms make it easier for individuals to access sustainable investment options and track their impact. As technology evolves, it will continue to drive innovation and growth in the sustainable investing space. When individuals, institutions, and governments work together, they can drive significant progress in sustainable investing. Collective action amplifies impact, encouraging more companies to adopt responsible practices. By joining forces, investors can help accelerate the transition to a more sustainable and equitable global economy. Let's look at a real-world example: renewable energy. Investments in wind, solar, and other clean energy sources have surged in recent years. These projects not only reduce carbon emissions but also create jobs and stimulate economic growth. By supporting renewable energy, investors can drive both environmental and financial benefits. Social impact investing targets projects that improve lives, such as affordable housing, education, or healthcare. For example, investing in companies that provide clean water or access to medicine can have a profound effect on communities. These investments demonstrate how finance can be a force for good, addressing urgent social challenges while delivering returns. Strong corporate governance is a key pillar of sustainable investing. Companies with transparent leadership, ethical practices, and diverse boards tend to perform better over time. By investing in well-governed companies, you support accountability and long-term value creation, reducing the risk of scandals or mismanagement. Younger generations are driving the growth of sustainable investing. Millennials and Gen Z are more likely to consider ESG factors and demand transparency from companies. Their preferences are shaping the future of finance, pushing businesses and investment managers to prioritize sustainability and social responsibility. Women are also playing a significant role in the rise of sustainable investing. Studies show that women are more likely to invest with purpose, considering social and environmental impact alongside financial returns. As more women take control of their finances, the demand for sustainable investment options continues to grow. Large institutional investors, such as pension funds and endowments, are increasingly adopting sustainable investing strategies. Their significant resources and influence can drive widespread change, encouraging companies to improve ESG practices. As more institutions embrace sustainability, the entire investment landscape is shifting toward responsible growth. Future of sustainable investing looks bright. As awareness grows and more data becomes available, investors will have even more tools to make informed decisions. Innovations in technology, regulation, and product development will continue to expand opportunities for sustainable investment, making it easier for everyone to participate. There are several myths about sustainable investing, such as the belief that it always means sacrificing returns or that it's only for environmentalists. In reality, sustainable investing can be profitable and is suitable for a wide range of investors. By focusing on long-term value and risk management, it offers benefits for anyone seeking to align their money with their values. Measuring the impact of sustainable investments is crucial. Investors use various metrics and frameworks such as the United Nations Sustainable Development Goals (SDGs) to assess outcomes. Transparent reporting and third-party verification help ensure that investments are truly making a difference, providing confidence and accountability. Transparency is a cornerstone of sustainable investing. Investors need clear, accurate information to make informed choices. Companies that provide detailed ESG disclosures and regular updates build trust and attract more investment. Transparency also helps prevent greenwashing and ensures that investments deliver real impact. Climate change is one of the biggest challenges facing our world today. Sustainable investing channels capital toward solutions such as renewable energy, energy efficiency, and climate adaptation. By supporting these efforts, investors can help mitigate climate risks and contribute to a more sustainable future for all. Sustainable investing also addresses social justice issues such as inequality, diversity, and human rights. By supporting companies that promote fair labor practices and inclusive policies, investors can help create a more just and equitable society. Social justice is an integral part of the broader sustainability movement. Innovation is at the heart of sustainable investing. Companies that develop new technologies or business models to address environmental and social challenges are often well-positioned for growth. By investing in innovation, you can support solutions that drive progress and create long-term value. There are many resources available to help you learn more about sustainable investing. Look for reputable websites, books, and organizations dedicated to ESG and impact investing. Joining investor networks or attending events can also provide valuable insights and connections as you continue your sustainable investing journey. The best time to start sustainable investing is now. Even small steps can make a difference, whether you're shifting a portion of your portfolio or simply learning more about ESG. Every action counts, and together we can build a more sustainable and prosperous future for everyone. Sustainable investing is more than a trend, it's a powerful way to align your financial goals with your values and make a positive impact on the world. By considering ESG factors, supporting responsible companies, and staying informed, you can help drive change and build a brighter future. Thank you for joining us on this journey. Remember, every investment is an opportunity to make a difference.